Welcome to the Invested Dads Podcast, simplifying financial topics so that you can take action and make your financial situation better. Helping you to understand the current world of financial planning and investments, here are your hosts, Josh Robb and Austin Wilson.
All right. Hey, welcome back to the Invested Dads Podcast, a podcast where we take you on a journey to better your financial future. I am Austin Wilson, research analyst at Hicks & Zerker Capital Management.
And I'm Josh Robb, director of wealth management at Hicks & Zerker Capital Management.
Today, we are back with part 3 of our episode where we have a conversation with Shaun Meloy about questions that people have just about the world of finance, as we said last week. If you have not listened to part 2, go listen to part 2. If you've not listened to part 1, go listen to part 1.
That's right.
But we're going to take you right now to part 3.
Crypto.
Yeah, crypto.
Is it a viable, legit investment, or is it just a scam?
Okay, Josh, I'm going to start.
You start, Austin.
Crypto.
Do we have like a
currency.
difference of opinion here?
I mean, I think we're pretty aligned on this.
Are you a little more bullish on it, or
It depends on the day of the week, really.
Yeah.
Cryptocurrency is based on a fantastic technology, and the fantastic technology that underlies it is the blockchain. The blockchain is essentially very public, very visible, very transparent data transfers, right? That's essentially what the blockchain is.
I hate it that I know more about this part of the blockchain than I do about 401ks.
Yeah, right? Because it's exciting, right? It's exciting.
Yeah.
Oh, I know how the blockchain
Yeah.
works, but a simple 401k,
I don't know. Hey, that's
whatever,
great.
man. Just put it in there.
Put it in there.
But go on, please.
Yep. So essentially, it's extremely transparent and fast and efficient way to transfer data on the internet. So specifically cryptocurrency, there are other things that use blockchains, but specifically cryptocurrency harnesses that technology in order to have really transparent and fast and quick and easy and affordable ways to transfer money is really the way that that's done. Now, that's the technology component, which is fantastic.
But there's also the philosophy behind
The
it.
philosophy, well, there's multiple philosophies behind it because there's multiple cryptocurrencies, right?
Mm-hmm.
But
There's like
there's a
bajillion
bajillion
of them.
But
You can make
generally
your own coin
speaking,
if you wanted.
Yeah.
we're working in the world of what's called decentralized finance.
Yes.
Decentralized finance, DeFi, is something that people who are really bullish in the space love and people who are not really hate because there is no oversight, there's no regulation, and really no protection for, I'm going to use
it's
air
the
quotes.
Wild West of
Yeah,
finance.
for quote-unquote investors, quote-unquote. I would call cryptocurrency at this point fantastic technology, but if you're using it as an investment, pure speculation. Because we have no guarantee. We just saw cryptocurrency fall from $60,000 a Bitcoin to 20 to 12 to 20 to who knows where it's going to end up. But it's right now it's $18,000 a Bitcoin. So if you were all excited at $60,000 because you love the technology and think it's the best thing for the world, well, the technology hasn't changed, but the price has, and you have no protection that ever protected you for any losses. This has never had any oversight or regulation.
There's no insurance on
No.
it. Like right now, if you took $1,000 and dropped it in the bank,
Yep.
and the bank folded,
FDIC insured.
your money's insured.
Yep.
Like, do you get all of that back, or do you get
To a
like
certain,
percentage?
all
to a
that.
certain, well,
Up to
the-
250.
yeah.
What does it say? So, like, if you have anything less than 250, you're going to be made whole.
Exactly.
As where with crypto,
You could lose it all.
you're like, what?
So if you have bid on or bet or put all your money in a really speculative coin, Dogecoin, for example, comes to mind a year ago or whatever, and it went to zero,
To the moon.
then you are essentially screwed. Like
Yeah.
you have no money and no way to get it back.
Yeah.
Now, I think there are some cool things that, specifically looking at the two largest cryptocurrencies in the world, Bitcoin being one. It's the most well-known. It's the largest in terms of market
It's
cap.
the granddaddy.
It's the
one-
granddaddy.
It's like the originator.
The
for
way
most
the
part.
technology works in terms of having the ability to create more that gets harder and harder, the halving process, if you're familiar with that, as you mine it, is fantastic math. Like, it's really, really cool to nerd out on. And the fact that you'll essentially never get all of them out in the world means there's always a finite resource, right? 21 million
Because they've said
Bitcoins.
they're going to stop mining. They're not going to continue to mint coins. Like, they're going to stop at a certain point.
There will only ever be, I think, 21 million Bitcoins. However, the mining gets harder and harder the closer you get to that point. So the computer work that goes into mining the Bitcoin gets harder and harder.
Which means the mining farms get bigger and bigger and bigger. To
And use
harness
more
power.
energy and resources, which is what everyone hates for it. So that's Bitcoin. But Bitcoin is based on the fact of being digital gold, right? It's a finite resource. It's all about supply and demand. Now, Ethereum, on the other hand, it can be used to buy NFTs. It is now had transferred to what's called a proof of stake, where you're not mining Ethereum anymore like you do Bitcoin.
Yes, because they transitioned it, right?
They just
and that
did.
addresses a lot of the energy needs.
It does.
Or
yeah.
a lot of the energy concerns.
So now essentially you, as a user of Ethereum, you can put your Ethereum up for stake, is what you call it.
Mm-hmm.
And essentially your Ethereum is helping to ensure the stability of the blockchain. And in exchange, to get new Ethereum in the world, you are compensated with new Ethereum for what's called a staking reward. So that is the change there. But that technology is very different than Bitcoin. But those are the two most popular ones. I would say both speculative, really cool, not really should be counted on for any sort of investment return, even though theoretically it could have periods of fantastic performance. It also can have periods where it falls out. And full disclosure, I own both. Don't recommend either one of them.
Yeah, so let me get to this. Let me first.
Yeah.
Last year, the New York Times had a fantastic podcast on Dogecoin. And
Yeah.
I constantly think about all those people that were like, no, man, I'm holding.
Yeah.
And I'm like, where can we do a follow-up?
Yeah.
on
Like
this?
in a
Seriously?
couple year or two.
Yeah.
Because I remember thinking, man, these people are real, like they are disciples.
Hodl.
now.
Mm-hmm.
And so I hold in my hand my current Coinbase account,
Oh,
which
yeah.
Coinbase is a marketplace to
Yep.
where you can
Yes.
buy
The
these-
wallet. Yep.
The wallet. Yeah,
Yep.
that's actually another app.
It is.
Yes.
They've got
They
Coinbase.
got another app. Yep.
Then you've got your
Coinbase wallet.
Yep.
that you use to transfer money or purchase or
Mhm.
whatever. So last year, just as like the Dogecoin thing was like really, and Bitcoin is really becoming like now it's a pop culture reference now,
Yep.
because I've known about it for a long time. It always seems so unstable to me.
Yep.
But I was like, okay, apparently crypto's here to stay in some form or another. Like it's not going away.
Yep.
It's just going to continue to be something. I was like, I'm going to get in just to have an understanding of it. So that way, if it really does like finally find a foothold where it's stable and it's not so speculative, maybe it's tied to something that, because they've tried like to have like safe coins,
Yeah.
and
Right.
stuff like that
Yeah.
undergird the value of another coin or whatever. And those things have even then have like bottomed out.
Oh, yeah.
Stable
When-
coin was bad.
Stable coins weren't so stable.
Yeah. But so I bought $10 of Bitcoin
All right.
and $10 of Ethereum.
Yep.
All in.
That's a pretty low stakes investment, like just
Yes.
to play around.
Yep.
And then they gave me like, well, since, like, cause I just sat on that $20 and didn't do anything. And so then Coinbase is like, well, we'll give you another $10, like probably trying to goose me a little
Oh,
bit.
yeah.
So I've got $30 in on crypto since last year.
All right.
The value
How
of
you
my
doing?
Coinbase
How you doing?
is currently sitting at $13.30.
There you go.
I believe it.
Yeah.
13, and I look at the little graph that it gives you in there. And
It's
I'm
like
like,
this.
just
Yep.
nosedives.
Yep.
Like,
There is some interesting reasoning behind this. So cryptocurrency did exceptionally well coming out of COVID. First of all, people had more money than they knew what to do with and more time on their hands than they know what to do with.
they're like me.
But what also happened is this correlated at the same time, the Fed lowered interest rates to zero, which made what's called discounting for things like stocks, meaning future earnings and future growth becomes very much more valuable. So growth stocks, NASDAQ, tech stocks did fantastic during the same period. So you had this big rally in tech stocks and growth stocks, cryptocurrencies, all at the same time because money's free. Money's easy. It's just whatever you want, whenever you want it, right? So then what's happened this year is that money has become not free. Money has become very expensive very quickly. Interest rates have gone up, which has made people take a lot less risk. So tech stocks have fallen because valuations are under pressure because of higher rates. And with that, the whole risk on play that has been happening since 2020 fell apart. The floor fell out in the early part of the year. So that's why cryptocurrencies have been so tightly correlated with tech stocks. It's the ultimate risk on play because there's no more risky quote unquote investment than cryptocurrency. So you just extrapolate the amount of risk that you would have with normal tech stock or whatever. And that's what crypto has done this last year. It's crazy.
Yeah. And from my standpoint, the SEC, which is who regulates us, has yet to define it as an investment asset. It's still not classified by the SEC.
It's
But
property.
So it's property is how they look at it.
But yet more investment funds like
Yes.
Goldman Sachs or whatever have decided we're going to dabble in it.
Well, they do that through the use of ETFs based on futures contracts is usually how all of these different companies are getting around futures
And what's
contracts.
an ETF? Like,
So an
okay, 'cause
ETF,
I don't know.
yes, exchange traded fund, similar to a mutual fund, but in a wrapper that is traded in real time, day to day, on the stock exchanges. and ultra visible and ultra easy to.
It's built the same way as a mutual fund, where it's a basket
pooled
of
investment
something.
vehicle.
Yeah, but mutual funds only trade at the end of each day. So if you said, I want to buy a mutual fund, you would submit your order, and technically you would not get that until the end of the day, because then they take all the orders for buys and all the orders sells and send it to the mutual fund and say, here's all your transactions for the day. And the mutual fund then says, okay, here's all the new money we got, and here's anybody wanting money, and they trade those out and then say anything left over, we're increasing our investments in. Or if there's more sells than buys, they sell a little bit of their stuff to cover the cost. But mutual funds do that at the end of each day. An ETF says, same thing as we have a basket of goods, but they're traded during the stock market time. While the market is open, you can make that transaction at any point in the day, and they take care of it.
So you could buy and sell
In the
something
same
in an
day.
ETF
Yep.
in the same day.
Mhm.
Like, I
Correct.
bought it, and then 10
I'm
minutes
I'm
later.
happy with it, and I'm done, or sell it,
Conditions
or
are
whatever.
great.
just like a stock.
Yeah.
Okay.
Yep.
There's similar structure. There's some little nuances to them, but they're both a basket of something.
Mhm.
So an ETF or a mutual fund, these ETFs then have used future contracts to,
Which are regulated by the SEC,
Yep.
which is how they have oversight.
and the future contract then is based off of a cryptocurrency. So it's their way of investing in crypto before the SEC says it's a security you can invest in. It's
I'm gonna be very honest.
That's a lot of.
This all seems very shady.
Well, it
It's-
kind of is.
It's not shady, but it is very, very
inconsistent is what it is.
Well, it's very risky in that if someone sees this ETF, they're just looking it up and see it.
I'm buying Bitcoin.
And the way it's worded, they're like, oh, I'm holding cryptocurrency. Well, you're not. And depending on how future contracts move, you may see a different return than the actual coin it's trying to invest off of, because the future contracts, you're holding on what they think the price will be in the future.
Right.
But if that doesn't follow suit, then they may have to sell those contracts for a loss, more so than what the price moves. So it's a very risky way of getting exposure to something that you may not fully understand how they're getting there.
Well, and you don't actually get the benefits of having the cryptocurrency, of being decentralized and the ability to transact the actual currency itself, because you don't hold the actual currency yourself. Like with a Coinbase wallet app, I go into my Coinbase wallet, I have my Bitcoin, I can send Shaun $5 of Bitcoin. That's my Bitcoin going to his Bitcoin account, like our wallets linked. When you're doing this through a futures-based ETF, you're going to the exchange to sell a share of the ETF, but you never actually touch the underlying at all. Now, there is another option to confuse you further, Shaun. It's called a trust. So Grayscale, you may have heard of. It's a large manager of crypto trusts, they call them. They're not even ETFs, but they're traded like a stock. And essentially, the Grayscale Bitcoin Trust and Ethereum Trust, they hold Grayscale the assets. So they hold Bitcoin and Ethereum, and then you buy a share of their chunk of that. So you get a very similar, not the same, but very similar price movement to that as well. But it's not even necessarily an ETF, it's a trust. So it's very noisy.
Long story short, it's a new thing to invest in potentially. But until there's more regulations, you're going to see the volatility you've seen.
So not exactly a scam, but risky.
Yeah.
Like it's an emerging financial tool.
Yeah.
It's emerging tech for the most part. I mean, the blockchain's been around for a while. But
Some coins are scams, I would say that.
Yeah.
yeah.
The underlying technology.
But some funds are scams
Yes.
too.
Yes.
I mean, you
Right.
can make that
Yeah.
argument,
Yep.
right?
Yeah.
Like,
Yeah.
Mhm.
But until there's regulation and more oversight, the average investor, it's kind of a play at your own risk type of idea. And that's why we're very hesitant ever to say anything, especially as an advisor. Like the SEC regulates me and they're saying this is not investment. So I really cannot recommend it to anybody. Now, if clients are asking me, people, the conversation is just that. Understand what you're getting into before you do, and don't risk more than you're willing to lose, because at this point, there is no underlying safeguard, right? If a bank goes bad, there's a safeguard there, right? When you're investing in the stock market, there's no safeguard, but there's a historical underlying of how
record.
this works, right?
Yeah.
You understand what's going to happen and where you're investing and how that goes. And so those are, and really, if someone does something illegal, there are safeguards there. There are lawsuits that you can recoup your money from. Cryptocurrency is just a free for all right now, right?
Yeah,
and you're seeing some issues there because once that money moves, it's hard to get it back. And
and like when we're talking about the whole crypto world, there's so many ways for people to hide behind things. Like we talk about NFTs.
Yeah.
And you talk about the Bored Apes Yacht Club.
yes, oh yeah,
The whole Bape thing, and how when
Yeah, it's weird.
they quote unquote doxed the owners of it. like how that was a big thing. But then there was a bunch of people on the other side of the fence saying, no. This is why we make people register, why we make people put their names on the line.
Right.
So that way we know who we're dealing with, because
Yep.
we don't want to deal with a bunch of hucksters that are going to take us. As where with the crypto scene, the NFT scene, there's so much more anonymity there that to me is like, that's the terrifying thing
Yeah.
with it.
I would say there is a flip side to that coin where you could say, okay, this area is not regulated. And it's because it's not regulated that it has the potential for truly ridiculous returns since it came about, right? So if you look at least until recently, Bitcoin since inception, trailing returns have beaten all other asset classes because it's starting from a small base for one, getting a lot of adoption for two, but also because it's been unregulated and people have been interested in that. When we do, because I believe we will, get to the point of some level of regulation in the space, you do cap upside. You cap downside, but you cap upside in the space because people will feel a lot more safe in it when it's regulated. So it's just going to be a lot more organized. It's going to be less of the wild, wild west, like you said, and more of the 1920s or whatever, like slightly more modern, but still not quite safe.
Yeah. And I think people hear that word regulation, and it always has a fairly negative connotation to it. Right. But I feel like even in a regulated market, when you see something that's drastically increasing in value and people are going, oh, wow, that's hot, let's get in on it. There's also a mechanism in place on the regulatory side that says, okay, so why is it? And then it triggers that safeguard to investigate. Is this legitimate? Or is there something that's
we saw that the other day.
That's why the stock market.
Twitter, which is a publicly traded company. And Elon Musk is in the process of potentially buying it out, all this fun stuff. Well, there's been a back and forth, and just what was that, a week or so ago?
News pending
that they were going to complete this deal. Twitter jumped during the trading day. They actually
54.20.
They
Right up,
paused.
boom.
They paused trading on Twitter. That's that regulation you're talking about to say, whoa. This is out of the norm. Let's make sure everything's right.
It was like what, 30 some?
It was such
it
a
was
huge
unlikely.
jump.
That's the market baking in the fact that it's unlikely that the deal would go through. Well, then all of a sudden news comes out. It is likely the deal's going to go through. Wow.
So they paused trading temporarily to make sure that, again, the average investor wasn't getting screwed on this whole movement, that everybody was understanding the same thing. And so that's the regulation that's missing in Bitcoin is you could see it move, up, down, different directions, and there's no stopping it.
It could go to $1 in a minute.
Yeah.
And
There's no stopping it. Whereas the stock market has safety guards put in place.
Going
Triggers.
back to the pandemic, we were texting back and forth, and the stock market is just tanking.
Yep.
And they had to pause trading.
Yep.
Well, what's that mechanism called? I can't remember now.
Well, there's different trigger points where where the market will close at a certain drop down percentage, and we hit it like
It's
multiple times
down.
in a day. It
Both
goes up and
directions.
down.
Yeah, and they paused trading for what, 15 minutes, just for everybody to take a breath.
Yep.
And part of it too is the automations, right? Some of that trading they're realizing is triggered by automation. So if they pause it, it gives people time to adjust that. Because if they say, if you're a trader and you put in these orders where you're saying, okay, if it moves down by X percent, start selling, and that triggers, and then that triggers the next person, then there's this compounding thing. They pause it all, just say, hey, let's stop this. Make sure everybody actually understands the orders.
Go grab a cup
of
coffee.
Yeah, and see where you are. And then if it happens again, it goes from 15 minutes, and then they extend it, and then it can actually increase.
They can close it for the day if
they need to.
Point.
Yep.
But with crypto,
it's
none of that.
And not only that, there's no close to the market.
Well, that's just like earlier this year. I remember a day the crypto world fell apart. Like Bitcoin was down like 18-20% in a day.
Yeah,
that wouldn't be able to happen that way that quickly in the stock market.
Yeah.
So probably one of the values then of having a market that closes is because you close for the day, you process all your orders, finalize all your paperwork, and you go home and you go to bed.
Think about it.
Now, while it's 3:00 and you're sawing logs, the market's closed.
Yep.
It's the Nikkei's open or whatever. These other foreign markets are open and they're doing business, which is ultimately going to impact us, right? Like because we're in a global economy, what they do is going to impact us. But when you wake up, at least
it's close to or similar to what you went to bed with.
Yeah, but and even then, if something drastic happened somewhere in the world overnight while you were sleeping, that could negatively impact our markets, right? They're regulated to the extent that they can sort of blunt some of those impacts. As
Yes.
where in the crypto market, like it's
a free for all.
it doesn't close.
Yeah.
No.
You already
Trading.
missed it.
So if it's 3 a.m.,
Holidays,
You missed it.
everything.
and it all tanks
Yep.
out, like you wake up and all of your coins are
Gone.
just wiped
Yep.
out. Oh no, my apes.
Yeah.
Yep.
Now, one thing that people do like about cryptocurrency is the idea that in theory, it hasn't worked out this way because of what I talked about with the risk trade, but in theory, you should be able to have an asset that delivers uncorrelated returns from your other assets.
What? No.
That's a lot of words. A lot of words.
Back up. Explain those
Yeah.
to me.
Okay, so in theory, it doesn't always work out this way, as we found out. The crypto and the stock market has fallen apart
I feel
equally.
like you're using in theory with incricing frequency with this crypto discussion.
That's because it's very theoretical at this point. So on paper, let's say that's a little bit different.
It's the same.
In a perfect market environment over the long run, stocks go up, bonds go up, but at a different pace and inverse sometimes to their stocks. And a lot of times understand that relationship. This year's been different, but and a lot of times you understand that relationship. But one of the theses of holding crypto is that the supply and the demand story behind cryptocurrency should not be tied to the fundamental movement of the stock or bond market. That's another way that people are interested in it for. And that has completely fallen apart this year, as both are down very sharply. But as it becomes more widely adopted, I think that is part of the plan. Think of things like gold should be an uncorrelated return to the stock and bond market, but it's not perfect.
It at this point is a very risky asset. And so risky assets all tend to move the same direction in a down market. Is if I'm scared of this, I'm going to be scared of the other things that are potentially going to move at the same volatility or speed. And so I think at this point, at least, yeah, you're going to see them all similar. But the goal in general is, gold is a precious metal and it reacts to supply demand on if somebody wants to buy more gold, then the price goes up. And in theory, coins that even if they're digital would work similar to that in that supply demand is going to drive the price move more than any other underlying fundamentals.
Yeah.
Because there is no underlying fundamentals.
There are underlying
there.
fundamentals between stocks and bonds,
But
not
not digital. There's nothing underneath digital currency, right? It's just the supply demand. So that should drive price movement, but it doesn't right now. It's also driven by
risk.
risk, tolerance, your ability to say, I'm comfortable at this price based on what historically has happened, all those things. So there's just no correlation right now for anything, which is why, again, we're hesitant to tell anybody to put any more than they're willing to risk losing altogether.
Because, Sean, I'm with you. I have a Coinbase account I've lost money on.
And you know what really stinks? Like, if I forget my login for my account, the world that you guys operate in, like say my bank account,
Yeah.
I forget the login for that. I call the bank and they verify
get it,
my
yeah.
identity.
Yeah.
You can get
Here
in.
you go. We'll reset your password.
Mhm.
If you lose your login for your wallet or whatever you're using to manage your Bitcoin, you are hosed.
Mhm.
Yeah.
There is
No
way
one to bail you out.
There is no way to recover that other than like some like code that they gave you. That's a randomized generation of words or something like that. You have to make sure that you save.
Yeah.
And if you didn't save it,
You're in trouble.
you're done.
Yeah, you wouldn't be depressed. Google some of those stories of people who have lost
Oh,
their
The guy
ability to log in.
who lost his
Yeah.
hard drive in the landfill or
Yep.
whatever.
And he'd been petitioning for years to try
Millions
to
of
get back.
dollars and
Yeah.
maybe billions of dollars of Bitcoin.
Yeah.
There used to be a podcast from Gimlet Media called Reply All, and they did one episode. They had these different themed episodes. One was tech support, where they're trying to help somebody with some technical problem that they had. Bitcoin was really entering the public space now. A lot of discussion on it. And this girl had emailed one of the hosts and said, hey, I used to have a wallet. I bought some Bitcoin because I did a European trip. I knew that there was some interchange there. And I used some of it. And then when I got back, I just forgot about it. And I know that there's a balance on there. I don't know how much is in there, or I don't even know how much it's worth now because this was a couple years ago. And in that span of time, Bitcoin had gone
Shut up.
to the
Yeah.
moon.
Right.
But she was like, I don't remember my login. Is there any way to recover it? And so these guys are really good. It's a show about the internet essentially,
Right.
but they went through all the paces and they're like, there's no way to recover your
Yeah.
wallet. Like you're done. It's just there.
It's
it
lost
exists
forever.
It exists.
It's on the
somewhere.
blockchain.
It exists somewhere on the blockchain, but we cannot access it. And she was like, darn.
Well,
Like,
and that's another aspect of
That's
the
a bummer.
finite amount of supply, specifically of Bitcoin, is that there's a lot of the Bitcoin blockchain that is lost. There's lost coin, like lost tokens, lost access codes. So like that piece of the blockchain will never be fully utilized for what it should be. It'll also never be traded. So the supply is essentially less than is actually.
yeah. And I mean, it's not like gift cards that you get to a business where
No.
the balance that goes unused is just free money for the business that they get, but they're going to reinvest that in their employees.
Right.
No, this is just gone.
It's just gone. Like nobody benefits from it.
Exactly.
And you hear people actually intentionally burning some of that too. When there's a lot of coins out there and they want to increase the price, they'll intentionally burn. So they'll move coins to a dead account to intentionally get rid of them. It's just
Something,
crazy concept.
some other thing you couldn't do if it was regulated.
That to me,
That's price manipulation.
As I say, that to me, as somebody who's not in the finance game, seems like market manipulation.
It is.
Oh, it is.
Absolutely.
But
it's
expressly
unregulated.
designed to move your price up is by limiting supply. But,
See, I told you this was shady.
It is.
Some aspects of it for sure shady.
So, long story short, don't risk any more money than you're willing to see go to zero.
I feel like I've heard that bit of wisdom from other people as well when it comes to Bitcoin. Like, don't invest any more
where
than
Josh
you're
got
willing
it.
to lose.
And even when you're starting in the stock market, I don't expect the U.S. stock market to go to zero because it's comprised of businesses.
It's highly diversified.
It is. And of the businesses to go to zero, that means every business is bankrupt. And so I don't think of that.
We're probably like in a nuclear war at that point.
Yeah. And
We got
no
bigger
one's even
problems
logging
than your
in at this
401k
point.
Something
balance.
worse is happening
Yeah.
than your investments.
But that same concept is true for new people is don't put too much in that the volatility is going to cause you to panic because you're not going to learn those habits you need to be a long-term investor if you put too much in to begin with. Because if you started, let's say at the beginning of this year and you put in everything you had saved up and worked hard for, and then all of a sudden you're down 25%, if you weren't aware and ready going in that would be a possibility, you're panicking right now and you're probably never going to trust or invest again. So starting out early on, don't invest more than you're willing to tolerate that up and down risk until you get comfortable with it. And again, it's not an age thing, it's an experience thing because we have people who are in their 80s that are invested heavier than people that are in their 20s because experience is greater than your age. Because some people say, well, the older I get, the less aggressive I should be. And there's some truth to pieces of that. But that just because I'm older doesn't mean I need to be less aggressive. It's what is my tolerance at this stage in my life for the up and down of the stock market? Because there's one thing that's guaranteed is the stock market is volatile. Volatility is not bad because volatility includes the up and down movement of a stock market. You just got to be comfortable.
Volatility is like priced into things, right?
Yeah, the volatility is part of what you're paying for. So you get
risk
the premium,
Yep.
meaning I get the return or the reward for sitting through or adapting to that up and down movement.
Something
And so
with no risk will get no return.
Yeah. So the savings account at your bank gives you very little return because you're not taking any risk.
What return?
Yeah,
Exactly.
right. And
Pennies.
then as you step up, so if you leave the savings account and you move to a bond, the bond's going to pay you a little more because you're taking on a little bit more risk. And then if you move from there to the next step and you keep going, then you go to large U.S. companies. There's risk there, but they're not as risky as a small startup company. And so your risk return, you get paid more. And often it's a premium, a risk premium is what they call it. But the idea is if I'm taking more risk, I want something for that. And that's where you step up. But you don't want to go beyond where you can tolerate. Otherwise, you're going to make investment decisions off of emotion instead of your goals and your needs at that point. With anything, don't put more in than you're willing to risk and understand what that risk is that you're taking.
So is this the wisdom of having a financial advisor? Is this you making like, this is my pitch for why you need my services? Because I'm going to sit with you through when things are losing value. I'm going to sit with you and hold your hand and say, no, don't panic.
Yeah.
I have seen this before.
Yes.
I've seen it multiple times now.
Mm-hmm.
Let's just wait it out. Trust me.
Yeah.
That's what you're paying me for.
That's right. I'm less connected to your money than you are, right? I'm not the one that worked really hard for it. So my emotional attachment to your money is a little bit less. And so I can hopefully make that rational decision when the emotions are all high to say, well, I know from experience, these are the things that we need to do to move forward.
But even when it's on the upside, and things are
that's
going,
the greed
things
piece
are going,
that you got to be really careful with.
things
too.
are going great.
Yes.
You can also be like, hey man, things have been swinging up a little too
Let's
long
make an
now.
adjustment.
We need to make a few pivots here and there just to make sure that when it starts to swing back the other way,
Your position.
we're in good
Now,
hands.
I always say, and this is one of the things our firm says is, just advisors in general, for people who don't have the time, the desire, or the expertise. Because those are the pieces that somebody, if they have the time, they have the desire to learn, and they have the expertise to know what they're doing, you can manage the money on your own. And I have no problem, and I've met quite a few people who are successful at doing that, and they don't need an advisor. But if you're lacking one or two or three of those things, an advisor may be helpful.
I feel like those individuals, those top tier individuals, are probably few and far between.
There is, but there are some. And again, the expertise maybe is to understand I don't have to be complex. And so their expertise allows them to make the decisions to say, I only need to own this and this, and I'm diversified, and it's less work for me, right? Mm-hmm. It's not, I'm day trading in and out. Like, you don't have to be a day trader to be a good investor. If you just understand what my goals are, and you do the expertise and research to figure out what gives me the best chance to get there, you may own 1-2 things that cover you for that, and you're good to go. And then means I'm not watching it daily. I don't have to spend that time. Yeah. But in general, most of the people who do a good job with it are those that are able to look at it rationally and not make those snap decisions based on emotion.
There's a certain amount of discipline that goes.
There is. Okay. It is. It's discipline, training, education. Yep.
See, I've known people that you kind of touched on them a little bit that had that like curiosity to understand it and to pay attention to it and have that discipline to say, I'm going to give myself $1,000.
Yep.
And I'm going to manage that. I'm going to buy some stocks, sell some stocks, maybe invest in a fund here, something, whatever. But I'm not going to go beyond that. And whatever I make off of it, I'm going to reinvest. But I'm stuck on that, and I'm not going to be risky about it. If I start to lose money, I'll pull back a little bit, regroup, and then
Or we even have some that say, let's go back to your 401k. Right? That's my primary source of retirement, my 401k. And for most people, that's what it is. They'll say, you know what? I'm not going to take the risk there. I'm going to choose a pretty stable, something that's, long-term and not mess with it. And then maybe on the side, I'm going to have $1,000 or something. I'm going to play with that. We call it a play account, but the concept is that gives me the freedom that if I go to zero on my $1,000 account, if I'm saving my 401k, it's not ruining my life, right? I'm going to be sad I lost $1,000, but my retirement plan is not destroyed because of that. That gives them the time and place to learn, to try things out without having a detrimental impact. And what we see a lot of times is they'll just, choose from their menu and choose some pretty good investments and say, my 401k is good. That's my stable. That's going to consistently grow over time. It'll have ups and downs, but I know what I'm getting there. Then over here, I'm going to buy a little bit of that more speculative thing. I'm going to say, oh, here's a startup company I just heard about, or here's a new technology I can invest in. I'm going to put a little here and there. And I may get really good. There's be years where I totally outperform my 401k, and I'm going to be like, man, I wish I would have invested some of this. And there's going to be other years where that's just getting destroyed. I'm like, boy, I'm glad my 401k is not doing that. But that's your education piece. And I find that people who do that in the good markets, they're always bragging and like, oh man, you know how far up,
I am absolutely slaying right now.
Yes, right. And then in a year like this where it gets kind of crazy, they're really glad that other piece is there doing the long-term, more slow, steady, turtle approach to investing, which is historically the best way to do it. But that other one taught them, right? I'd rather learn the hard lesson on $1,000 than I would on my 401k.
Yeah.
And that's really where that I would strongly encourage somebody who's just interested in learning, take just a little bit of money that you can afford to lose completely and use that as your learning tool. Maybe it's $100. Because right now, with technology, again, you can open up an account at E-Trade, Scottrade, Fidelity, Schwab, whoever, and you don't need a lot of money. You can put $100 in to get started, right? You don't need
you don't need to buy a whole share anymore. You can buy fractional shares of whatever you want.
Yeah, so I could get started with $100 just to see and learn on my own, how does this work? And when I own a stock, what does that mean? And you could try that. Okay, now that I own the stock, it just went down. Why is that? And if the education, I can just kind of look. And usually those places, Fidelity or whatever, you can click on and see what news just happened. And then you see, look, the stock that I own, they just did an earnings report. What is that? They said they didn't earn as much as they thought they were going to. That's why their stock, like the education comes. And the fact that my $100 is now $80, I lost 20. I'm not happy, but that's better than my $100,000 401k losing $20,000. I'm really upset about that.
Yeah, and I think what you're saying right now is set a small amount of money that you're going to quote unquote play with. But you're doing that research. So if you don't know anything about your 401k, but you've got this $100, $200 that you're just goofing around with, like trying to figure it out. Like, how much knowledge do you gain about your 401k and what it's doing just by osmosis? Like, you're just picking
a
it
lot.
up.
Yeah, you're slowly getting there. And the nice thing about 401ks is a lot of times companies will help you with that. The 401k they're using, there'll be somebody you can call. A lot of times they won't give you actual investment advice, but they can help you along to describe. You say, all right, here's what I'm looking for. And they'll say, okay, this grouping is what you're trying to find. You pick out of here. And a lot of 401ks now are adopting what Austin mentioned was a target date fund. And I'm actually a big fan of those in 401ks for people who don't have the time to look at all the investment choices. Is what you're choosing is you're picking a date in the future when you think you may be transitioning out of this job or out of work in general. So like, 2040 or whatever. And the concept of these funds is to say, okay, the closer you get to a transition period, the less volatile you're going to want to experience. Because if you're going to retire in January of this year, the last thing you want is to see your 401k take a 20% haircut. So you need less exposure at that point in the stock market just for that transition period. So what this does is this fund will just start aggressive when you're young and then slowly get less aggressive the closer you get to whatever that arbitrary date is. And that concept then allows you to own one thing that's going to be adjusted over time that you don't have to spend too much time thinking about. Somebody else is going to do that for you. And then it allows you to then educate and learn somewhere else, but then you could apply that over time. The more comfortable you get, you could come back to that target date and say, you know what? Now that I understand, maybe I'm going to add a little layers onto that. I'm going to own a couple more funds in that menu that give me that exposure to the things I've learned and understand that I want to have in there.
I'm going to adjust the dial a little bit.
Or maybe I'm just going to take my target date and move the date because I know what I'm going to get out of that.
Yeah.
I may move it later. So I go from 2040 to 2050. I just got more aggressive because I understand the farther out the number, the more aggressive. And you can make those adjustments because now you've learned what you're doing. But I'm a fan in 401ks of getting advice, asking around, like, who can I talk to with this? Do you have somebody? Talk to your HR person. Is there someone that's a part of this plan that I'm allowed to talk to? Sometimes they have an advisor that's attached that you can call and talk to, and they can help you. If not, if you have your own advisor outside, most advisors will help advise you on your 401k anyways. But if not, those target date funds are usually a pretty good starting point because there's going to be adjustments made. Somebody is helping move that along the way for you.
Gotcha.
Yeah. Shaun, wrap us up with your thoughts on dad jokes.
I'm not for them. I told you I have a very aggressive brick wall limiter on
anti-pun.
You don't like humor.
No, I enjoy humor quite a bit. Is this the dad? Because I feel like, especially in the context of a podcast, because you're essentially making a historical record that one day your children, your offspring,
are going to look back and say he was hilarious.
They're going to look back at this and go, this is really not what I wanted him to leave me with.
Oh, you have no idea what my legacy is for my kids.
It's mostly dad jokes.
Oh, 80, 90% is dad jokes.
Yeah.
Here's
a couple dollars, but a lot of dad jokes.
I have pushed all in on the dad joke. Yes. Like all of my stock is in the dad joke.
Crocs and dad jokes.
And glasses, because all the eye rolls have to be hurting their eyes. I'm guessing that, but
we got a good vision.
Yes, that's right. That's where it's at.
Well, this has been fun. I've really enjoyed it.
I have too. Shaun, thanks for being here, and hopefully we can do it again real soon. And thank you for listening this Thursday. Please remember, you can always share this episode with anyone that you find that might have been asking about the smorgasbord of things that we covered today. So send that to them, and always feel free to email us any ideas you have to hello@theinvesteddads.com. Once again, thanks, Shaun, for being here, and talk to you next Thursday.
All right, talk to you later.
Thanks. Bye.
Thank you for listening to the Invested Dads podcast. This episode has ended, but your journey towards a better financial future doesn't have to. Head over to theinvesteddads.com to access all the links and resources mentioned in today's show. If you enjoyed this episode and we had a positive impact on your life, leave us a review, click subscribe, and don't miss the next episode. Josh Robb and Austin Wilson work for Hicks & Zerker Capital Management. All opinions expressed by Josh, Austin, or any podcast guests are solely their own opinions and do not reflect the opinions of Hicks & Zerker Capital Management. This podcast is for informational purposes only and should not be relied upon for investment decisions. Clients of Hicks & Zerker Capital Management may maintain positions in the securities discussed in this podcast. There is no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Past performance may not be indicative of future results. Indices are not available for direct investment. Any investor who attempts to mimic the performance of an index would incur fees and expenses which would reduce returns. Securities investing involves risk, including the potential for loss of principal. There is no assurance that any investment plan or strategy will be successful.